Welcome to Your Average Investor. Today we're going to be talking about Expedia and seeing if it is a buy or not. Now, if you're not sure what Expedia is, EXPE, they are a travel-related company that helps people book flights, cars, hotels, etc. Basically, anytime you do a Google search for something like car rental or book a hotel in San Diego, they're going to be one of the top search results in the sponsored ads and often one of the top search results in the organic search results as well. They've done a pretty good job of positioning themselves as a top company for booking. Now, what's interesting about Expedia is they do not own the hotels themselves. They simply aggregate that. So if I'm saying, hey, let's find a car rental in St. George, Utah for whatever reason, let's search that. And now I'm going to get a bunch of results from all sorts of different car rental companies in the St. George area. So in this case, I've got this one by Hertz, I've got these ones by Enterprise, Alamo, all sorts of different companies. So they're just aggregating everything together and helping me theoretically find the best price online. Now, what's really interesting is it looks like they also run Google ads on their site, which means they're going to be generating additional revenue from those Google ads. So hotel rentals, car rentals, all sorts of different things. And you can even plan your whole trip there. If you say, hey, this is where I'm going, this is when I want to go, they'll find your flights, cars, packages, things to do, stuff like that. So with that being said, are they a buy right now or not? Expedia recently posted earnings, literally last night, yesterday, and after an initial spike where it looked like things were going good, all of a sudden they crashed down, and today they've dropped about 13.5%. So yet from yesterday's close, yesterday closing around $136 per share. Right now they're sitting at $117 per share. Now if let's look at a long-term perspective on Expedia. This is dating all the way back to 2005. You can see here in 2005 they were trading at about 20 bucks a share. Down in 2009, great financial crisis, they came all the way down to $6 a share, and they've mostly been climbing since then, reaching looks like they had a good range here between $100 and $140 per share ever since 2016 or so. And then here's the big COVID dip, and then they came right back up and rocketed after COVID, and then came right back down. And they've been playing in this range again, a little bit lower range this time. So where they were in the range of 100 to 140, now the range has been more like 90 to 120, with a recent spike all the way back up to 160. And now this dip brings them back to $117 per share, which is actually at the top of this previous range that they had just broken out of. So that being said, is it worth buying Expedia right now? Well, let's look at things from a fundamental perspective and then a technical analysis. We'll talk about some pros and cons and go from there. So here's what you need to know about Expedia. We've got earnings per share, $5.31, year-over-year growth, 58%. Here's the 5-year trend. This is really interesting. So 5-year trend, it looks like for the last 4 years they're doing pretty good. You can see here 377, 2020, this is COVID. Of course, there's not as many people traveling because of the lockdowns and whatever else, so they're going to post a massive loss. And then 2021, they come back up. They're still posting a loss. 2022, back to a healthy profit of $2.18 per share. And 2023, they posted a very large profit of $5.31 per, not profit, earnings of $5.31 per share. Now, Expedia used to pay a dividend. COVID happened, and then they nixed their dividend, and they have not brought it back yet. So that's interesting, right? If you're looking for dividend plays, Expedia has not yet brought back its dividend, and I don't believe there's been any news that suggests that they will. If they do, that could be an added bonus, and that would certainly cause a little bit of a spike in the stock price as people jump on board to start claiming that juicy dividend. That being said, let's look at their dividend history, because even though they did pay a dividend, they, there we go, they maybe never actually had that high of a dividend. So let's just take a look at their dividend history. You can see the last payment here was 2020, And their first dividend was back in 2013, started at 15 cents per share, grew to 18, 24, 30, 32, 34. So it did grow almost every year. They never dropped the dividend back until they dropped it entirely. But let's just assume they reinstate it at 34 cents per quarter per share. That's going to give you, there we go, got my calculator to load, $1.36. And we're going to divide that by the current stock price. So that's a dividend of about 1.1%. That's all right. Yeah, we got a 1% dividend. Okay. So the next question we got to ask ourselves is, are they likely to continue being able to operate at this kind of a level, $5.31 of earnings per share? Or is there going to be another major event like COVID that takes them down? Or is there going to be a large competitor that comes along and all of a sudden boots them out as the top dog in the market? Obviously they have some other competitors, right? So if I do a Google search for car rental, of course Expedia is coming up, but now I've also got kayak.com, I've got Priceline, Hertz themselves is showing up. So all sorts of different companies are going to be competing with Expedia for that. So I have to ask myself, do they really have a moat? Do they really have something that's defensible in this? Or is it just that they happen to be the top dog from the past X number of years, so likely they'll continue to be the top dog for the next several years? Are they doing anything innovative that's going to drastically increase their ability to provide a good return to investors? Or are they just going to keep on doing the same thing that they're doing, which is help people find flights and rentals and hotels and more or less plan out their trips? And I think that Airbnb could be an interesting competitor that moves along into this space. They've already tried to do stuff with Airbnb experiences. If you guys aren't familiar with that, it's kind of a failed experiment if I remember right, but they have their experiences where it's like, oh, in addition to going and staying in this place, why don't you go and do this thing that this local host puts on, whether it's a tour in some place, or a safari, or looks like there's some sort of homemade meal type thing here. So Airbnb, I think, has a realistic shot. If they wanted to, they could pivot into, hey, you've booked your Airbnb, why not rent a car while you're here? And I don't know if Airbnb is considered more popular or less popular than hotels right now, but it's an interesting thing. So next up, let's see. Let's look at their gross profit margin. Looks like it's been pretty steady. It's actually growing, 72, 79, 81. And let's look at debt. Long-term debt to capital. Total assets, net profit margin. And I'm just realizing that this is a little bit cut off in the screen, but that's okay. We're looking at all the important stuff. So, no dividend again. Let's look at it from a technical analysis. So far, I'm not really liking it from just from a consumer perspective. Like, sure, they're going to be around, but I've got to look at this from a opportunity cost. If I'm putting my money into Expedia, is that going to give me a better return than putting it into Apple or Nvidia or the S&P 500, right? Like, if you look at it, like if you were to have bought Expedia at the beginning of, say, 2016 on this big dip here, and let's just say you got it like at the very bottom of this dip, so Expedia for like $90 a share. Well, as of today, yes, you'd be up. You'd have increased from $90 a share to 116, and you would have been paid some dividends along the way. That's what these little green dollar signs down here represent, as different dividend payments. But your return in just sinking your cash in the S&P 500 would have been way bigger. You'd have gotten more dividends. You would have had a better return. Like this, a 1% dividend, the S&P 500. If you buy SPY, that pays a 1% dividend. So let's look at it from a technical analysis, right? We've got a couple of interesting lines here. I'm going to put some price lines in. So we've got this range that it's been playing in really all the way since 2015, 2016. And it's broken out a couple times both above and below, this being the largest recent breakout. And then we had another one here. To me, it looks like we're just going to continue playing in this same range. So if there's no dividend and there's no appreciation, I don't see why I would invest in this company. Now, if I think that they're going to be doing something really innovative soon, then sure, maybe I invest. But it's like Expedia, they're not a big tech company, they're not a big AI company, they're not doing something crazy with building new hardware. So what value are they bringing? They're just aggregating information online, which that is valuable for consumers. They're aggregating information, and I just see this thing as kind of a uh, range bound here, and they've got pretty big risk if something else like another COVID lockdown happens. Then they're going to be dropping pretty significantly. So for me personally, for us personally, at Your Average Investor, I would not buy Expedia right now. If you own it, would I sell it? I don't know. That's a personal decision. That's based on your individual investment results. If you bought it here at $6, right on the very low of the Great Financial Crisis, and you've had an incredible return, maybe you hold it and hope that they reinstate their dividend. Yeah, especially considering it's not paying a dividend right now, I don't know if I'd buy this. So thanks for tuning in to Your Average Investor. If you haven't already, please subscribe to our channel for more content like this, and we'll see you next time.